Hi guys, today's a quick one. We're breaking down what happened on Wednesday. And on Wednesday, there was Kevin Warsh's first press conference as Fed chair right after the FOMC meeting. And honestly, the presser itself was good, pretty much exactly what we expected. What was bad was the dot plot. So let's go into it. Uh, so the dot plot. This was the bad part. 9 out of 18 Fed members now see a hike this year, and the market took that and ran. It's not pricing roughly an 85% chance of rate hike this year. 85%, when just a couple of days ago that was about 60%. Yeah, we had more than 40% chance of rates staying flat this year. So that's a big jump, and that's basically why the market didn't like this Fed meeting. So what do I make of Warsh himself? Well, he seemed kinda a little bit hawkish, but not hawkish on rates, more hawkish on inflation versus the job market. He really sounded like he wants to pin inflation back to 2%, and markets don't usually love that. Markets like when Fed is worried about protecting the job market. We actually didn't get much from him on jobs at all. The one thing he said was that the job market is healthy right now, but the read I got is if he has to choose between lower inflation and hot job market, he picks lower inflation. And I think that's also a part why the stock market dropped a little bit. Though it's not certain, we don't really know that yet because the job market is pretty healthy, I would say right now. Maybe it's not thriving, it's not like very hot, but it's not bad. And the inflation is the issue, but it really seems like he wants low inflation, and he will do everything to get to this low inflation. And this might not be very great for markets. And this is the interesting part. Even though he sounds hawkish on inflation, it actually seems that he wants rate cuts. It's like he doesn't believe a rate cut in this environment would even be that inflationary. He seems way more focused on the Fed's balance sheet, which, to be honest, we already knew that. We knew he's fan of QT, but now it's just much more visible. So the way I read it is he's open to cuts. He just wants to get the balance sheet right first. I mean, maybe not first. He wants to do both. And I just realized that I was showing you guys the wrong slide. Basically, now I want to talk about this slide. So one thing he did was he killed the forward guidance. And basically he said, listen, we don't want you hanging on our guidance and then us having to change it. Some guy actually asked him before this quote whether the markets would be more volatile. And honestly, he answered it really great. Read it if you want. He really sounded like some kind of the politician. So really, the communication between the Fed and us investors seems quite good, I would say. But back to the quote itself. So, well, honestly, I kinda agree with him. Right now, the markets are focused on what the Fed is going to do instead of the rates themselves. And I mean, actually, this is how the market works, right? The bond yields, for example, are way more important than the rates themselves, and bond yields are basically markets trying to come up with what would be the rates in the future, and he sees a bunch of the inflation data, job markets data, etc. But when Fed gives guidance and then something changes and Fed has to change the guidance, well, this also creates a lot of volatility. So it's not really that bad, and we shouldn't worry about it at all. Okay. One of my favorite quotes during the whole this interview. Uh, Let me actually read it. We cannot have a very significant effect on particular prices, the price of oil or even a dozen eggs, but our job is to make sure those changes don't broaden, don't have second and third order effects. So what he's saying is we shouldn't be fighting inflation that comes from an oil spike or tariff or other stuff that Fed doesn't control. We should worry about the demand inflation. Actually, he talked a little bit about the demand versus the supply inflation also, but well, basically, it's the thing that Fed can change, can actually change, and what's actually also important is he's not saying ignore the energy completely. He says he cares about it, but only the second round effect, like um, well, basically making sure that it doesn't snowball. Like oil goes up, that pushes shipping costs up, that pushes the inflation up. Well, people then want bigger wages, wages go up, margins getting squeezed, prices go up, right? And so on and so on. So actually, the oil going up could have some type of snowball effect. So it's not like ignore it completely. Raise rates if you need to, but it's like the Fed should care and might even hike if energy spikes, but only if it sees the snowball getting out of hand. So I actually quite like this way of Fed working. Sometimes I feel like the Fed is too much, the worries too much about the energy prices, and right now we can see it. So this might be a good change if Kevin Warsh could somehow switch the focus more on the core inflation or some other inflation metrics on the demand side more. Uh, okay, one more thing. He announced like big reforms in Fed. He basically announced five task forces. Market didn't really quite liked it. I mean, maybe not the market, but people. People say that it's basically consulting and it wouldn't work at all, but it basically forces Fed to rethink how it's making its decisions. So I think actually it's great. The Fed uses really old tools. Uh, Now with all the data we have, we can scrape the internet, use AI, all of that. We can genuinely predict inflation better and predict what effect rate changes and Fed communication actually have on markets. I think it's a great move. It's just not easy and it's not fast. I think that it could really take for us to see some effects up to a couple of years, because Kevin Morse said that the first data he would have would be mm, at the end of this year, but I don't believe there's gonna be any big changes this or the next year. Maybe 2 years from now, but we'll have to see that. Okay, so how the market actually react? How did the market react, and what do I think? So the market dropped, but remember, we just had a huge run up right before this drop, so it's really not that bad. And today we're bouncing again, so honestly, not bad at all. Here's what's interesting about the move. So semiconductors, and I mean not the Nvidia, but Micron, AMD, even the neo clouds, they went up on this, or actually they didn't drop like other names related to consumers, but basically every other names dropped except for these names. And the market thinks that the money is going to flow into these names no matter what. And honestly, the market is right, but I mean, it's kind of a short term thinking for me. I believe in these companies, I have them, but come on, these companies go up when they're the most volatile, when good companies that have a steady stream of revenue uh, like go down on such news. I don't think it's great. I was looking to maybe take some. I was looking for a reason to take a little bit more profits, and I think I found one. I just want to buy the companies like I don't know, not a financial advice, but I'm buying, for example, Microsoft right now. It got hit on based on this news when really its revenue shouldn't be really be affected by that much when AMD and Nebius actually went up. So that's what I'm doing. But as always, do your own research, guys, and come up with your own solutions. Okay, to sum this up, what does this all mean for the stock market? Honestly, I think it's pretty neutral. It really didn't change that much. The main thing is just that the FOMC members are slightly more hawkish than we thought they were. And that's basically it. So don't worry about it, guys. Everything's going to be fine. And thanks for watching. I'll see you in the next one. Bye.